Today I'm going to talk through telco and a particular technology stock that's got a catalyst looming. So what I thought I'd do, rather than run through everything, is really talk through the three large cap stocks that I think are topical, and then two smaller cap stocks with some catalysts. So starting with Telstra, they report tomorrow. That's the 13th of August. We've lined up a presentation to the Morgans Network on the 26th of August, which will be largely a Q&A session, so feel free to dial into that and ask any questions you would like. In terms of this year's numbers, we know where we stand, so we don't expect any surprises there. I guess, though, the key areas of question mark or risk are, as I've said here, the dividend, the impact from international roaming in FY21, and also in FY21, the potential impact from small to medium business closures. So they're the kind of areas that we've got question marks over. This year in particular, you may recall, towards the end of the year, they downgraded their guidance towards the lower end, effectively took $500 million off EBITDA due to lack of international roaming and a few other things COVID related. What they didn't do back then was tell us the full year impact of international roaming. All telcos seem to keep that very close to their chest. Our estimate is that it's close to $700 million of EBITDA, so on a full year basis that is. So we think we've got it covered next year, but we just don't know, unfortunately. So there is a bit of uncertainty on the outlook there. And obviously that has implications for the cash generation, the underlying earnings, and also the dividend. What we do know is that last year Telstra actually didn't stick to their dividend payout ratio despite only recently bringing that out. So they've got a cent up their sleeve from special dividends that they could have paid last year if they stuck to the bottom end of their guidance range. So we think they'll probably bring that through this year just to support the earnings. The dividend, I should say, but that is just a risk we want to flag with everyone. That said, we think that Telstra is a stock that will rally once there's certainty there. As you all know, it's hard to get certainty in these markets. Markets and investors don't like uncertainty, so we think once you get some certainty, you know what the dividend and the earnings base are for the year ahead, it's likely to rally on that. The second stock to talk about is TPG Telecom. Result out on Friday the 21st. This is a stock we are very fond of, but just heading into this result, we honestly don't know what to expect. We've never really heard anything in terms of forward-looking guidance from this company. This will be the first time they talk to the market as a merged entity, so it's a bit of a question mark as to what they're going to say. So that'll just be watched closely because there is a fair amount of uncertainty with TPG, a lot of question marks because there's not any guidance on what happens when you put the two businesses together. That said, we still think there's some really good value in that name and a team that has an excellent track record of execution. And then finally on the large cap front, NextDC result out Friday. We know they'll hit their guidance, so not concerned there. Looking forward, I expect them to provide guidance for the year ahead, and I think it'll be around consensus and our own numbers, so we're not expecting a disappointment there. That said, this is this stock's rallied very hard. It is one we would like to buy. We think it's a high quality business, but we're just not buyers at these levels, so we're hoping to get a pullback to accumulate that name. Just worth pointing out that they'll do roughly $100 million of EBITDA this year. Based on the megawatts that they've contracted or the customer contracts signed and in the bag, they'll do about $200 million of EBITDA in the next 3 or 4 years. And also worth pointing out, in the last 6 months, they have given customers nearly 60 megawatts of options. For context, in the first 9 years of their existence, they only sold a total of around 60 megawatts. So in the last 6 months, they've given free options to these cloud providers, which total all of their sales for the last 9 years. Massive step up there if those options get exercised, and if that happens, you can see a path to this business making more than $300 million of EBITDA in the next maybe 5 or 6 years. So there's not many stocks out there that you can look at and go, I can see the EBITDA and the cash flow in this business is going to continue to grow. It just comes down to what do you pay for that. So two stocks with catalysts. Number one is Superloop. I've just discovered it had a catalyst this morning as well. They've appointed a new CEO. Drew Kelton's been running the ship for a little while. I thought he was a good operator, but there'd been, I guess, some questions from a few investors, as to whether he was going to be there long term. They've now appointed a new CEO, so maybe that when we get to hear from that person, we might get a little bit more confidence on what's going on there. But just mentioning that, they'll have a result out on the 24th. I think the key thing for Superloop is we all know it's been in a big downgrade cycle for a number of years, and most importantly, that downgrade cycle is over. if you look at the guidance they've provided, they're just shy of EBITDA guidance they provided 12 months ago. That's despite COVID-19 basically putting a handbrake on international travellers and international students. So they did take 2 mil off their EBITDA guidance in February, yet they still almost hit that 14 to 16 mil that they provided in August. So actually proof that they're managing the business very well. I won't run through this chart, but as you can see, basically we've got some reported numbers and the trajectory is the start is lower than the reported and the exit rate is higher. The point why I bring this up is if you take the numbers that are in the market from this company and you just double the second half 20 EBITDA, they'll do 19 mil. If you take what I think the exit rate is, based on a mathematical average, they'll do 26 mil of EBITDA next year. So don't know what the final number is. I doubt it's 26, but I do think it's above 20. And that would mean they're doing at least 40, possibly even 90% EBITDA growth next year. So this business has finally turned from downgrading to upgrading, hopefully, and certainly at least to growing the EBITDA at a healthy rate and generating free cash flow next year. Also, just worth pointing out that what people got excited about in the early days of Superloop was the fibre business, and that got lost along the way with Big Air and the challenges that came with that. But if you look at the fibre business, they've signed $16 million of new business in the last year. That's up 46% year on year. So that fibre business, the high margin, attractive recurring part of the business is growing at a healthy rate. So it really comes down to just watch for the outlook here, and consensus and myself sit at around $22 million. I think hopefully it'll be in that ballpark and you'll be able to see the trajectory of this business and the earnings going up. Second stock is a microcap stock, so perhaps not for everyone, but looks really interesting to me. Its results also out on the 24th. If you look at this company, it's gone from $1 billion market cap to $40 million market cap in the space of about the last 6 years. EBITDA's come down an awfully long way. They've said they'll hit their 20 mil EBITDA guidance, which makes it look incredibly cheap, given a 40 mil market cap, 66 mil EV. The question on the minds of pretty much everyone is, do the earnings in this business continue to decline or stabilise? And if they stabilise, this thing's worth a lot more. So I would say just look at this business, look at the outlook commentary. If guidance for FY21 is something around the 20 mil mark, then it's one of those stocks you can buy with your ears pinned back because they've finally hit the base and started to stabilise the earnings. I think that is the case, but if you want to err on the side of caution, just wait for that result. Just a couple of names I wanted to just mention because they're obviously well held across the network. Firstly, Megaport. Look, we don't expect anything new and exciting there because they released their fourth quarter. We already know all the key data points. Just worth mentioning, though, that the strong Aussie dollar is going to be a headwind for Megaport. If you look, probably 3/4 of their revenue is booked outside of Australia, so when that gets converted back into Aussie dollar, stronger Aussie dollar, it's worth less. In terms of the catalysts, it's really around the next product they'll bring to the market, which is a software-defined wide area network, and we may hear something from them on that in August. If not, it'll be a little bit later on this year, but I think that's the next catalyst investors are looking for. And Opticom have just released on Friday their unaudited results, so we know that number. They beat their prospectus forecast. Number was pretty much in line with our expectations. We don't expect them really to provide anything significant in terms of the outlook commentary because clearly it's all about the Unity Wireless takeover offer for that stock. So clients need to be aware you need to be voting by the 2nd of September, a little earlier to get the stuff in there for the scheme meeting on the 10th. And then just touching on Data3, we know it already. I guess it could disappoint in terms of the outlook commentary. This is a company and management who execute very well, but their guidance is always very vague. It's something along the lines of we aim to do better next year than this. And that's pretty hard to get excited about. Plus, I think they'll point to a tougher second half, given a really big bring forward tougher first half, given a very strong bring forward of business into the second half of 20. And Vocus is one where I just think there's better value elsewhere. We know they'll hit their number. There could be a little bit of risk around the outlook guidance, but I just look at the telco sector and I think you've got three large, well-capitalised, full-service players and Vocus, which is the fourth. So I'd be happy to switch that one into something like TPG or Telstra. So in summary, our three key picks, Telstra, I think there is a little bit of downside risk there, but we think its certainty will be rewarded. Superloop, we think there's a decent upgrade cycle coming through for this stock and certainly some good earnings growth. and iSentia on a 30% normalised free cash flow yield. If those earnings have stabilised, it's worth a lot more and the share price will go up quite a lot. So watch those 3 stocks for catalysts. Thank you.